from the time Bear Stearns collapsed, it took 7 months to get a bailout. But in 2023, when we see 3 banks collapse, they had a bailout in 6 days.
Exactly. And they're very much, they're very much aware of the fragile nature of the system. And, they have one tool, which is a printer, and they will use it, which is the name of the book, right? The big print, because we've had 2 big prints. We had one in 2020. We had another in 2008. And we had a little one before that in 1998. But, I think that each one is going to kind of get bigger. And each one chips away at the foundation of trust in the government and in the Fed and in currency. And so, anyone who saves capital has a choice of places to put it. They can put it in bonds, they can put it in stocks, they can put it in gold, they can put it in Bitcoin. And to me, big market indicator that trust is rapidly, slipping is, Bitcoin at 106, it was, come back there soon, and gold at 30, it's like 30.50 now, which is stunning to me, actually. I knew gold was going up, but it's gone up faster than I even anticipated. And I think that's just because more and more people are coming to the realization that you have and that I have, that is, the system is broken, and there's not an easy way out. There's not an easy way back. And we're going to have to return to some kind of a sound money system here at some point.
Yeah. A lot of people are maybe caught off guard looking for a big event to come. They've been told over and over and over, the dollar's going to die, the end of the dollar's coming, blah, blah, blah. Yeah. I remember a few months ago, I had a buddy call me up. I forget what the news trigger was, but he saw something on the news, and he texted me, Mark, I need to talk to you. Is this all going to collapse? I'm going to wake up tomorrow, and my money's going to buy half as much, stuff. Yeah. And I said, it already has. Like in the last 5 years, you can buy half as much house, half as much gas, half as much, right? So it's like, everyone's waiting for this big event to come that they're going to lose half of their money, but I was like, you already did just lose half of your money. So maybe they don't understand that. Is that, I know you wrote the book, The Big Print, sort of as a public service announcement. You said you sort of wanted mainstream to kind of understand what's going on. And is that the message? What is the message you're trying to get through?
Yeah, well, the message I'm trying to get through, the book's divided into 2 parts. The first part is why the monetary system runs the way it does and how it's broken. And I try and point out how unfair it is that certain people can borrow very cheaply and other people have to pay 25% for credit card interest rates. And so I try to point out that the system has been constructed to benefit people who know how to game it and actually benefit from inflation, and I want to get the average citizen angry with the fact that they're being silently robbed through this, inflation. And they know it, and that's why there's so much political dysfunction. They know it because they go to the supermarket and things are costly or much more costly, and yet their wages aren't going up. And so they're getting squeezed. And of course that makes them angry. And so Team Red blames Team Blue and Team Blue blames Team Red. But neither one of them is looking at the Fed and blaming the real source of it. Money supply, as you know, it went up 40% in 2 years in the COVID pandemic. And that was basically like saying to anybody who had worked for 20, 30 years, had some savings, we're just going to cut the value of savings by 40%.
Right.
Yeah, it's terrible. And so I want to first explain that to people so that they don't fall for the politicians who are saying, well, it's the greedy corporations. No, it's not. It's the Federal Reserve. And then once I explain that, of course, they'll maybe be angry. And maybe, that's a depressing message. I hate to deliver bad news, but it is what it is. But then I want to deliver the good news, which is there are ways to protect oneself from that. In fact, there are even ways to benefit from that. And of course, that leads you to gold and Bitcoin, more particularly Bitcoin, because it's more asymmetric than gold, and it really, on a Bitcoin standard, people who've been living on a Bitcoin standard have been saving all their money in Bitcoin. There's a great a metric in the book that just shows the price of a house in Bitcoin, and even though the nominal price of a house has gone up over the past 10 years, the number of Bitcoin it takes to buy a house has gone down substantially.
Yeah,
and so.
Or said in another way, not nominal, but the U.S. dollar value of the house went up.
Well, that's correct.
But the Bitcoin price went down.
Yeah, it's all because the dollar's getting to be worth less and less per unit, obviously.
Right. I think if people just understood that everything is a trade.
Right.
Everything's a trade. So I could trade a house for labor. I could trade a house for oil or gold or oranges or rice or Bitcoin or dollars or yen or whatever. And when you start, so then you start to go, well, how much is it in oil or gold or rice? And not just U.S. dollars. You start to kind of see this a little bit more clearly that way. But I think sort of what you laid out, as you said, sort of the bad news is like, here's how the system works and sucks. Hopefully you're angry, but it is what it is. It also sort of shows like the inevitability of what's coming, right?
I think so. I mean, look, I try to game theory out how I could be wrong, and I've been wrong somewhat. I mean, I thought in 2008 that was the big one, and we were going to go to serious inflation, and I was wrong. They changed the rules. They started paying excess money on excess reserves. The banks held the money back, and we got an asset bubble, not really a consumer inflation bubble. But and I've often said to people looking at investing in any of the funds I'm involved with, the one thing that could make this thesis of monetary debasement not be true is if the government balanced its budget and, got serious about, allowing money to be fairly priced.
The odds of that are zero. So
right, exactly. I mean, thank you for saying that. I mean, to balance the budget, they would have to more or less cut the big categories by 50%. And boy, think about that politically. We're going to cut Medicare and Social Security by 50%. I mean, that's not going to get through. And defense, same story. Interest rates, I mean, those are hard to cut, unless the Fed drops rates because the market determines them in many, many senses. So, yeah, it's sadly, it's Keynes counseled. I mean, Keynes was, in my view, kind of a false prophet, and he counseled that, don't worry about doing these things to stimulate demand and get the economy healthy today, and the effect in the long run may not be good, but in the long run, we're all dead. Well, okay, fine, he is, but here we are, and the long run has kind of arrived, and then you glance at history, and you see that in history, when countries get to this condition where they have this much debt to GDP, it generally doesn't end up well. I mean, there's got to be some kind of a reset, and it doesn't necessarily have to be a bad scenario. I mean, it could be if we had enlightened politicians, we could do a structured reset. I mean, Roosevelt did a reset. He grabbed the gold, which I thought was bad, but he also devalued gold, which made 1934 the best year of the Depression in terms of economic performance. And the problem is pretty simple, Mark, as you know. We just got too much debt. We've used too much debt unproductively, and it's sitting out there weighing on us. And we've got to get debt and GDP more in balance. And the only way to do that is either write off the debt or let the debt collapse, which is very deflationary, somewhat of a depression, or to inflate, the money and let GDP grow in nominal terms a lot, so that without growing debt at the same amount, so that the balance between debt and GDP is much more manageable. Right?
Yeah,
and those are your two choices. And a good policymaker, we could figure this out. It would be painful one time, but then we'd be back on a sound money standard. It'd be good. But sadly, and in a prior podcast today, I was talking to somebody, and he said, "Yeah, but Larry, as you know, what are the odds that we're going to have an enlightened policymaker who's going to figure that out?" And I said, "Well, you've got a good point. The average politician doesn't really respond to something until it's a crisis.
Well, the problem is with obviously I think the Constitution, the American way, is the best government we've ever seen, but at the same time, there's deficiencies like having a 4-year window, for example, right? So
correct.
Everyone sees way too short term to go through that pain not being in power to see the benefits, the shade of that tree that they planted, right, kind of a thing. So yeah. I think what you lay out, the way I look at it is like, there's not a way to fix it. This is what happens when you're on a fiat money system. Mm-hmm. So that's the inevitability I was talking about. The dilemma of either continue printing or let it crash is the reality of that fiat money system. So I think then you have sort of a couple things. Like, number one, do they let it crash or do they let it inflate? The way I look at it is most people would much rather see their retirement accounts and their house and all their assets go up, even if the cost of gas and food goes up, opposed to seeing their retirement accounts and housing crash down if it meant gas was a little bit cheaper. So I think everyone would take the inflation, number one. So I think that, and the Fed has sort of proven that.
Yeah, people like rising numbers, even. Yeah.
So I think so my base case is they continue printing. Then the next question becomes, is it some inevitable event where like the point of no return it all falls apart, or is it the law of diminishing returns where each new dollar of debt gets us less growth than the one before it? And if, we used to get 50 cents of debt to get $1 growth. Today we get $1 debt to get 40 cents of growth, and eventually we get 20 cents.
I think it's even less. Yeah, I mean,
or less. Yeah.
Yeah.
And then
I think that's what's going on. I mean, the debt just it's not working, and the the currency will fail, and that's what we're kind of, and you've discussed it many times. You're very, good on it. Is the whole Gresham's law issue? The currency will fail when people realize when a large body of the people using the currency say, you know what, they can just never stop printing, and so maybe we'll transact in dollars because everyone accepts the dollar. But boy, nobody's going to save in dollars. The bond market's going to go away because everyone's going to know that the bond market is a sucker's play.
Yeah.
And in turn, the investments that are sounder, Bitcoin and gold, are going to just soar in value vis-a-vis the dollar.
Right.
And we're kind of seeing the early days of that. And I think that's going to continue and get more intense, unless they reverse the government spending,